It's a strange feeling when you look at a company that is absolutely crushing the numbers, making money hand over fist, but the chart is telling you to just stop, to freeze.
It's the classic investor's dilemma. You see the quality, you see the growth, but the timing feels off. And that is exactly where we are sitting today with HCA Healthcare.
Exactly. We're looking at the largest private operator of healthcare facilities in the US, the gold standard, as some call it. But despite the massive footprint, the signal flashing on the screen right now isn't go, it's wait.
That's right. And welcome back to the US Stockpicker Podcast. Today we are breaking down HCA. And you're right, A. If you look at the headlines, it's confusing. They just beat earnings estimates significantly. They reported an EPS of $8.01 versus the expected $7.46. That is not a small beat.
No, that's a statement. And looking at the year-over-year growth, we're talking about 28.5% EPS growth. For a company of this size, that usually signals a massive green light. So why are we seeing a wait signal on the near term and swing analysis?
It comes down to the difference between the business and the stock price. The business is firing on all cylinders, but the stock, it's tired. It's been on a structural long-term uptrend, trading well above its 50-day and 200-day moving averages. But right now, we are in a consolidation phase.
A consolidation phase. So the market is digesting that recent run-up?
Precisely. If you zoom in on the 4-hour chart, you see a drift lower. The price is hovering around $532, struggling to maintain momentum. We've got the MACD below the signal line and a negative histogram. In plain English, the short-term buying pressure has evaporated for the moment.
It's interesting you mentioned the drift because when I look at the broader context, the S&P 500 and the healthcare sector generally are showing some signs of weakness too. It feels like HCA is just getting dragged along by the tide.
That is a huge factor here. Even the best house in a bad neighborhood sees its property value dip occasionally. The broader market weakness increases the probability of a deeper pullback for HCA. We aren't seeing a crash, but we are seeing a lack of catalysts to push it past that $541 high right now.
So let's talk about the fundamentals for a second because I don't want to gloss over how strong this company actually is underneath this technical drift. You mentioned the EPS beat, but the cash flow numbers caught my eye.
Oh, the cash flow is the star of the show here. HCA is generating over $33 per share in free cash flow. That is immense.
That's dry powder.
Exactly. That's money they can use to buy back stock, pay dividends, or upgrade facilities without taking on dangerous debt. And remember, hospitals are capital intensive. You need expensive machines, expensive real estate. To generate that kind of cash flow while maintaining a 16% operating margin, that proves they are winning the efficiency game.
And that efficiency is key, right? Because the bear case for hospitals has always been labor costs. Doctors and nurses aren't getting cheaper.
Correct. Labor inflation is the constant threat. But HCA's revenue grew 7%, while their earnings grew nearly 29%. That tells you everything you need to know. They are managing those costs better than anyone else. They are scaling profitability, even in a tough labor market.
So we have a fundamental beast, a cash-generating machine. But let's go back to the chart. You said the signal is wait. If I'm a swing trader looking at this, or even a long-term investor looking to add, where is the pain point? Where does this drift stop?
The magic number we are watching is $523.
523. Why there?
That is the pivot support level. Right now, buying at $532 feels like chasing a stock that wants to take a nap. The risk of a drift down to $523 is higher than the probability of an immediate breakout above $540. The prudent move, the disciplined move, is to let it come to you.
Patience is the hardest skill in this game.
It really is. The daily trend is bullish, the weekly trend is bullish, but the 4-hour chart is diverging. It's acting as a drag. If you buy now, you're fighting that short-term gravity. But if you wait for a test of established support near $520 to $523, your risk-to-reward ratio improves dramatically.
Let's talk about who else is buying or selling, because I saw some mixed signals in the institutional activity. We had some big names trimming their positions, right? Alliance Bernstein, Abrams Bison, they were selling.
They were, and headlines love to scream institutional selling whenever a fund reduces a stake. But you have to look closer. This looks like standard portfolio rebalancing. The stock is near all-time highs. It's natural for funds to take some profit off the table.
So you don't see it as a loss of faith in the company?
Not at all, especially because on the other side, you have new investments coming in from firms like 8 Knots Management and increases from massive funds like CalPERS. The smart money is still very much present.
And the analysts seem to agree. I saw upgrades from UBS and TD Cowen.
Overwhelmingly bullish. We have 30 buy ratings versus only 2 sells on the street. And recently, 92 HCA hospitals earned the Health Grades Patient Safety Excellence Award. That matters.
It does. It's not just a financial metric, it's a brand asset.
Exactly. In healthcare, reputation is a moat. Being in the top 10% for patient safety differentiates them. It validates that their cost cutting isn't hurting patient care. So the sentiment is positive, the fundamentals are rock solid. It's just the technical timing that requires us to sit on our hands for a few days.
It's a quality at a reasonable price setup, isn't it? PE around 18x.
18 times earnings for a company growing at nearly 30%. That is very reasonable. The PEG ratio is under 2.0 in this market. That's a steal. But again, cheap can get cheaper in a pullback.
Right. So let's look at the risks. What blows this thesis up? If we are waiting for $523, what happens if it smashes through that floor?
That's the danger zone. If the price closes below the 50-day simple moving average, which is sitting around $505, the swing thesis is invalidated.
$505 is the line in the sand.
Yes, if it breaks $505, it means the intermediate trend is broken. At that point, you don't want to be holding the bag. The other risk, honestly, is the weekly RSI. It's at 71.68.
Overbought territory.
Borderline. It means the stock is extended. It's run a long way fast. When the weekly RSI is that high, it increases the risk that any broader market volatility, say a spike in the VIX, could trigger a deeper correction. That's why we don't buy at the top. We wait for the dip to cool off that RSI.
It makes sense. You want to enter when the rubber band is relaxed, not when it's stretched to the snapping point.
Perfectly put.
Okay, let's pivot to the strategy. We've painted the picture. Great company, tired stock, drifting lower. I want to nail down the specifics for our listeners who are looking at their trading screens right now.
Sure.
If I'm holding cash and I want HCA in my portfolio, walk me through the execution.
Ideally, you are looking at a swing horizon here 3 to 15 days. The near-term 1 to 5 day signal is just too weak. So you set a limit order. Do not buy at market right now.
Limit order. Got it.
You target the entry zone of $515 to $523. That's the sweet spot where support should kick in.
And if I get filled there?
Then you look for the bounce back up to the recent highs. Your first target is $545. Your second target is $560. That gives you a risk to reward ratio of about 1 to 2.5, which is excellent.
And the stop loss?
Hard stop at $500. If it goes below $500, you admit you were wrong and you get out to protect your capital.
Simple, disciplined. I like it. It feels like HCA is the adult in the room right now. It's not a flashy tech stock that's going to double overnight, but it's a compounder that's taking a breather.
It's a defensive compounder, and in a market that's feeling a bit shaky, with the SPY showing weakness, having a cash-rich, profitable hospital network in your portfolio is a very comfortable place to be, provided you buy it at the right price.
Provided you buy it at the right price. That's the mantra.
Always.
Before we wrap up, I want to touch on one last thing from the report. The AI angle. We hear AI everywhere, but is HCA actually using it, or is it just a buzzword for them?
It's legitimate. They are using AI to improve patient access and scheduling. It sounds boring, but in a hospital, scheduling is where you lose money. Empty operating rooms are expensive. If AI can optimize that efficiency even by 1 or 2%, that falls straight to the bottom line. It's another reason why that operating margin is so healthy.
Fascinating. It's not just robots doing surgery, it's the invisible efficiency.
Exactly.
All right, we've covered a lot of ground. From the massive earnings beat to the technical drift on the 4-hour chart, it's time to bring this all together for our listeners. Let's lock in the final game plan.
Let's do it.
Summarize the actionable steps based on the US Stockpicker Podcast analysis.
Here is the bottom line for HCA Healthcare.
First, news sentiment analysis. It is positive. The Analyst upgrades from UBS and TD Cowen, combined with the Health Grade Safety Awards, confirm that the business is healthy and respected. Ignore the noise about institutional selling. It's just rebalancing.
Second, fundamental analysis, strong buy. With 28.5% EPS growth and massive free cash flow, the valuation at 18x PE is attractive. The long-term thesis is intact.
Third, swing trade analysis. The current signal is wait. The 4-hour chart is bearish and drifting. We are in a consolidation phase.
Fourth, when to start investing, do not buy today. You need to wait for the stock to test established support levels. Patience is your edge here.
Fifth, what price point to start investing at? Set your limit orders in the $520 to $523 range. This is the buy the dip zone where the risk-reward shifts in your favor.
And finally, when to leave the market and risk mitigation. If the trade goes against you, you leave if the price closes below the 50-day moving average. The hard stop price point is $500. If it breaks that, the trend is damaged and you move to cash.
Crystal clear. $520 to get in, $500 to get out, and ride the fundamentals back up to the highs. Thank you for that deep dive, B.
My pleasure.
And thank you all for listening to another episode of the US Stockpicker Podcast. Keep your charts clean and your stops tight. We'll see you next time.
Happy trading, everyone.
The information provided here and on this channel is for general informational and for education purposes only. It does not constitute investment advice, financial advice, trading advice, or any other sort of advice. We make no recommendations regarding investment decisions based on this information. You are solely responsible for your investments. Please conduct your own research and consult qualified financial advisors before any investing.
Clickbait video title, HCA Stock Analysis. Why Smart Money is Waiting for This Price Level. Growth Stock Picks.